In the last video we talked about the two different types of PLIs, rate of return and margin. This video we're going to talk about how we think about picking between those two different types of margin measure, of profit level indicators. Turning first to rate of return measures have one particular significant advantage over margin measures, in that they actually may tell us something about the economic profit of the business. Therefore, instead of serving as just as a yardstick, they also serve as a measure of the reasonableness of the return that we're getting. To see why this is so, let's say that I have $100. See that I have $100 which I can invest. I have options how to use this. I could invest in a financial instrument that would pay me some sort of interest rate. I can invest what I will call in business number one, or I can invest in what I will call business number two. And because these are alternative uses of my funds, I would expect the profits which I make on these different investments to have a relationship with each other. So if I can get a 5% return by investing in a financial instrument such as a bond, I probably would expect a little bit higher return if I invest in business number one or business number two to reflect the increase in risk, but there would be some relationship between the profit I'd expect from those and the 5% return. So if I go out and I get a set of comparables that has a 8 to 12% rate of return on assets, and I compare that with 5%, I might say that seems reasonable. That seems like it's what the normal type of profit you expect by being in those businesses. If I go out and find a set of comparables that's getting a 30+% rate of return on assets, or return on assets, I would say, wow, that seems very high. I'm probably missing an intangible asset there. If I get a set of comparables that has -5 to 1%, I probably am reaching the reverse conclusion, saying these probably aren't giving me a number which is sustainable over time. So once again, instead of just getting a yardstick, I'm actually getting sort of a measure of the profits which are reasonable. Second potential advantage of the rate of return measures is that they may allow us to do a little more comparison across functions. I deliberately put in that we have potential for investing in business number one or business number two, and perhaps the rate of return I'd expect is the same for those two businesses. If so, I might be able to broaden out my set of comparables to include not only just comparables in business number one, but also comparables in business number two, or functions number one and function number two, and so we now have a different way of selecting comparables. Now let's look at margin measures. And as we'll see, with margin measures, the percentage margin really doesn't tell you anything about the return on investment or return on your assets. If we recall, in our earlier video, if we think about operating margin, we can think of and relate it to operating rate of return. We can say operating margin times the ratio of sales to assets equals the return on assets. And let me move these up here just a little bit higher. And so if we think about this, we can illustrate the following basic point. I'm going to just create a little table here, in which case we're going to have some rows and columns. And say we have an operating margin of 2%. And our sales to asset ratio is 0.5. So for every $100 of assets, we only have 50 of sales. Well, then that translates into just a 1% return on asset. If we take that same 2% operating margin and we have a sales to asset ratio of 2, we now have a return on assets of 4%. If we take that same 2% operating margin and we have a sales to asset ratio of 5, we now have a 10% return on assets, And then finally, if we take that same 2% operating margin and we have a sales to asset ratio of 20, we now have a whopping 40% return on assets. And so basically the issue here is we can have the same operating margin, but we may be getting very, very different returns on our investment. And so operating margin, lacks the advantage of the rate of return measures in that it really doesn't tell you anything about how profitable the exercise is in terms of economic profits unless you also look at the sales to asset ratio. While rate of return measures would seem to offer some advantages over margin measures because they provide information on the profits related to the amount which is invested in the business, while margin measures do not, anyone who's been involved with transfer pricing knows that margin measures are used much more frequently than rate of return measures. Why is this? First, measurement. And when we think about measurement, it is generally harder to get an accurate measure of assets used in the production of a particular product than it is to get cost of sales, operating profits. And there's a couple reasons for this. First of all, allocation. Companies generally will allocate costs very precisely, in particular cost of goods sold, and will have an accurate measure of the cost of goods sold for a particular product. For businesses, they often have accurate measures of operating margins. There's no similar allocations are done in many cases for assets, and so it may be much more difficult to actually get a asset measure for a specific product or product line than a margin measure. Secondly, there's the issue of accounting versus economic measures of assets. And the accountants can do a lot of damage to the economists in this regard. And to illustrate this point, say I bought a building in New York City 20 years ago. From an accounting perspective, we're going to have an asset on the books, we're going to amortize that asset over a period of time, and so now that asset will be at a much lower value than the price originally paid for it. From an economic perspective, the value of that building may have appreciated substantially over time. And so we have a fundamental mismatch between the economic investment that I've made and the accounting measure of assets which is on my books. And then finally, we can think about issues related to what I will call rent versus own. In many cases, I may choose to buy the factory which I'm operating in which case it's an asset on my books. Alternatively, I may choose to rent the factory or to rent certain equipment, in which case they're not on my books. And so we have two different businesses which have very different balance sheets simply because of the decision as to rent or buy, even though that really should not affect their overall profitability. I would note that these issues, while they're more serious for assets, also affect income statement items as well. For example, in my example of the building in New York, if I've substantially undervalued that business, or my accounting measures of that asset are substantially lower than the economic measures, I'm probably depreciating too much. And so my profits, the cost of using that building are understated in my income statement. But once again, we think these impacts are much less for income statement items than for balance sheet items. The second issue that may affect things is what I will call price-like. Margin measures basically tend to look a lot more like prices than return on asset measures or rate of return measures. If I look at a gross margin, it's fairly common for someone to go out, and a businessman might go out and say, I need to get a markup of at least 20% if I buy that product in order to make a go of it. Therefore, if I pay $100 for that product, I know that I need to multiply that times 1.2 and get a price of 120. That looks very price-like. Similarly, if I'm selling something for 100 and I know I need a margin of 20%, I know the most I can pay is around 80. Again, a very price-like type of measure. Things are a little bit less price-like when you get to operating margin measures or operating cost plus, but it still has a better feel and it looks a little bit more like sort of setting prices and dealing with prices to many businessmen and to many tax authorities than rate of return measures. And often this type of perception is important. That said, when we're using margin measures, which is what we normally do, we really have to understand that we're implicitly assuming that the ratio of sales to assets of the comparables and the tested party are at least broadly consistent with each other, because if they're not, we are likely to be sort of comparing apples and oranges and getting relatively inconsistent or distorted results. Thank you. Finally, It's important to know that you have resources, other resources that you can turn to. The 3 resources which are listed below are all from the Wiki. The Wiki definitions page, where you can look for return on assets, where you can look for operating margin, and it will provide you with links to various source material on this. Wiki, you can search for PLI or other terms, and it will take you to the pages in the Wiki for this. For the Wiki, the spreadsheet view, where you can go to technical topics, select either profit level indicator or comparability factors, which is something which is related to profit level indicators. All of these resources currently are the Wiki, but we are planning on adding some other resources, both in terms of additional videos and in terms of training material, very shortly. Thank you.